Hello, today I want to talk about dividend yields in relation to this comment. Yes, the share price of the counters go up, especially after the dividends have been announced. And I don't know, why are people saying that the NSC corporate action is outdated? Mine is as updated as 21st, which is today. So this is BOC. They declared a dividend of 10.35. If you go under the trading platform, for sure, the price has shot. The price has shot so much that because of the dividend. So that is very true. After the dividends are declared, the price shoot. You can see it's like inaenda juu. It's going up and up and up. It's already broken this ceiling. I call it the ceiling or the resistance, and it's going up. Before the dividend announcement, it was trading at around 125, but currently it's trading at 152. As at today, I checked, it was as at 152. Sorry, the market is closed. That's why you cannot see any buyers or sellers on this side. So as a smart investor, what are you supposed to do? Before you go ahead and buy the BOC at 152, do a calculation we call the dividend yield. The dividend yield is dividend per share divided by the current market price of that share, and you multiply by 100. And the current market price is the price that you intend to buy at that moment. Assume I want to buy BOC today at 152. So I'll take the price of the dividend of 10.35 divided by 152. I multiply by 100. I'm going to get a figure of 6.8%. So what that means, after investing 152 on BOC share, I'm getting a return of 6.8% in terms of dividends. Yeah, holding all other factors constant, kwa sababu kuna capital gains which may come later. But holding all other factors constant, I'm getting a return of 6.8% from investing 152 per share. Am I comfortable with 6.8% dividend yield? If you're not comfortable with that figure, wait for the book closure. The prices normally go down after the book closure. And if you check at the BOC, have they been paying dividend consistently? If they have been paying dividends for the past 5 years, so that means even in the years to come, they will still pay dividends. So after the book closure, buy your share when it's at a lower price than the 152. Maybe it will go back to 125 or even 120. And for future dividends, you'll enjoy a better dividend yield. So always do your calculation. Am I comfortable buying at this price, and what is the dividend yield? So there are two things that you consider when you are investing as a dividend investor. The dividends, how much has been declared, and also check the dividend yield. The other company which has declared dividend is BAT. BAT, as at today, it was trading at around 570 there. If you go to the BAT dividends, they declared a dividend of 60 bob per share, and initially they had paid a dividend of 10 bob. Even though you didn't get the 10 bob then, and maybe now you want to benefit from the 60 bob, when you are calculating the dividend yield, we take the annual dividend. So take an annual dividend of 60 plus 10, which is 70, divided by 570. Assume you want to buy BAT today at 570. What is the dividend yield? 70 divided by 570, you get a figure of 12.28%. Are you comfortable getting a return of 12.28% from investing 570? If you are comfortable, go ahead and buy the BAT at 570. If you are not comfortable, wait for the book closure, which will happen after 8th May. And maybe the price of 570 will come down maybe to 500, to even below 500. And maybe you can buy shares looking at the other future dividends which are coming year 2027 and beyond. But by then for BAT, a dividend yield of 12.28% and currently it's trading at 570. That is a very good dividend yield. So do your maths before you invest. So there is the first step of checking the dividends there, but also do the dividend yield. If the dividend yield is not mathing, wait for the book closure and buy for future dividend, provided the company has paid dividend in the last 5 years. It will still pay dividend coming years. Another one that I like keeping on checking, by the way, and this my own, it's Kengen. Kengen, I know most people don't like it because iko tu hapo, it doesn't move. Iko 9 bob, 8 bob, ikienda sana 10 bob. But if you check their dividend yield, it's quite attractive. Kengen, like last year, was it last year or early this year, they paid a dividend of 0.90. That was the annual dividend. If you divide that by the share price, say even average 9 bob, you'll get a dividend yield of around 10%. Most companies in Nairobi Security Exchange, they are not giving such good dividend yields. Even equity, take equity, you'll get a dividend yield of 8%. So do your maths. A share may be cheaper, like Kengen, you see it trades around 9 bob. Equity trades 70, 75, 60, but the dividend yield of Kengen is a bit high compared to equity. So do your maths. Even sometimes you can find shares which the dividend yield is the same. They have a dividend yield of 10%. But one share is expensive than the other one. So do your maths. But I'm holding all the other factors constant. The other thing that these few have said, when you sell at a loss when you buy before the book closure. What I tell people, don't sell a share when it's at a loss, especially if you have bought those good companies. When it goes down after the book closure, average down and bring the initial entry price down. Assume now you bought BAT at 570 for dividends, and then after the book closure it goes to 400. Buy more at 500, so the 570 comes down to around 500. If it goes to 350, buy more. Maybe the average price now comes to 450. Once they declare dividend last year, your dividend yield will be even around 15 or 16% because the price that you have for BAT then it's below and the dividends are high. So always play with your numbers in a way that you are in a win-win situation. Thank you.